Bart Chilton, let me go to you. Was your August ruined by this volatility? It was really something.
It was exciting. I mean, these days that you would normally be out in the bay sailing or something, you were watching Bloomberg and seeing what was going on.
Well, we like that you were watching Bloomberg. He's so smooth. Bart, when you look at the moment that we had over the last 2 weeks, is it a good volatility for making money, or do you just get under the desk and hide?
Well, it's good for some people. It's good for people that are fast enough to be involved in these markets and going in and out of them. But, you know, the guys that were short lost their shirts, some of them. So my main thing, Tom, is looking at the volatility between the commodity markets and the equities markets.
What do you see there?
There was a big correlation. You know, we've talked about before commodities being down for a year or so. Last year was the worst commodity year in 13 years.
Well, no, excuse me. Let's rip out the script here right now. This is very important. Bart Chilton leaves the CFTC, and they have their worst year ever. Continue.
You know, I don't want to take credit for that.
Okay.
Yeah. The bottom line is that these markets are interrelated. Even when we're talking about Brazil this morning, and you look at iron ore prices, one of their major exports. You look at coffee. So these commodities are key.
Okay, beautifully set up from Michael Wolff. Can you fold the correlations we're seeing over to your world of M&A, or the fancy guys like you just removed from the markets?
You know, when I look at this from the perspective of tech and media, and you look at how much tech has made up of the NASDAQ, you realize that the fundamentals of these businesses really haven't changed. So the prices from a share perspective may have, but in reality, the underlying fundamentals of both tech and media, they're the same. These are going to continue to be strong growth industries.
You know, Bart, I wonder, you look at regulating markets. Does all the recent volatility in the equity market raise questions for you about how we should be regulating financial markets?
Absolutely. I mean, I think Dodd-Frank has done probably more than most people want, but has done a good job at making our economy safer and lessening systemic risk. But things like circuit breakers, whether or not they're coordinated, where sometimes they shut down a market or halt a market for a few seconds, but not always identically. For example, 2 weeks ago we saw the big crash, the 1,000.
2 weeks ago, I saw 9:35 a.m. 1,000 points off the Dow.
And
Should there
ETFs,
have been regulation in place to make that impossible?
No, not regulation, but you need to ensure that the circuit breakers are harmonized. So the circuit breakers for the exchange-traded funds were different than the individual stocks. And so there's the arbitrage opportunity there, and traders aren't actually getting the right pricing information to make trades. So that's one key. The other thing is ensuring that these regulations across the world are harmonized.
Okay, Michael, you know, I look at M&A. I thought I saw 3 deals yesterday, $1 billion, $2 billion, $4 billion, First Data with an IPO. Today we'll talk about later. What is the pulse into autumn? It's the new year for you and for bankers and deal makers. Is there an uptick to it, or are you adjusted because of the August we had?
I think that we're in a moment. There's so many companies. Again, the area that I focus on as a consultant, both tech and media, there's so many different companies that are going to either be strategic buyers or finding themselves as too small to really go in the next wave.
Is that what happened with Media General and Meredith, a combination of television properties?
I think that concentration in television, you look at some of the other businesses like Tribune and NBC, it was hard for anybody to compete with a set of orphan stations. Putting those together made a huge amount of sense. It's going to be it is the second largest TV group.
What is the change in tone of CFOs right now? Do they just assume Janet Yellen's going to act and they're trying to get out in front with their financing with these super low rates?
I think CFOs, from an operating perspective, are looking at increasing margins. I think CFOs are trying to take more of the revenue and bring it to the bottom line. And whatever happens with financing in this environment is less relevant to CFOs than what's going to happen with the operating performance of their companies.
Michael, did you watch the Apple product launch yesterday?
Of course.
Yeah?
Of course.
Is this a company playing catch-up? I mean, all of a sudden we've got a Microsoft product manager on stage, and we've got a stylist.
I didn't think they were playing catch-up at all.
I mean, I don't think they're playing catch-up. I do think that they're getting ahead of a couple of things that have shaped them. First of all, they're getting ahead of the fact that the replacement cycle for phones has slowed down. So by offering an option where consumers can pay $30 a month and trade in their phones once a year, the second thing is they're getting ahead of the consumerization of business. The fact that they're offering a much larger iPad with a stylus means that they're going after the mobility sector, people who are working from their cars, people who are delivering.
It's just that Microsoft already made one of them.
Okay.